So basically, in a lot of regards, the Fed is very similar to a commercial bank. I mean, there are very important exceptions where it's not, but in terms of the over like arching details, it's actually pretty similar. So if you look at a commercial bank for a second, they have assets and liabilities. The assets exceed the liabilities. That's an important part of their solvency, and their assets generally pay higher interest rates than their liabilities. So kind of the purpose of a bank is to borrow money at cheap rates and lend money with a little bit more risk and a little bit more duration at higher rates, as well as collecting fees and things like that along the way. And so for a typical bank, their liabilities are mainly their deposits. So basically, when you deposit money in a bank, that's your asset, it's their liability, and interest rates they're generally pretty low. On the bank asset side, depending on the type of bank it is, they do mortgages, they do business loans, they do credit card lending, they do all sorts of different types of lending. And those are ones that are generally a little bit riskier, higher duration, but they pay higher interest rates. And so they can absorb some, small percentage of defaults, build positive capital, pay dividends, fund their operations, and maintain positive equity and positive capital. When you look at a central bank, it's very similar, but there's a couple different categories for their assets and liabilities. So their liabilities are one, banknotes, right? So physical cash in circulation is a liability of that country's central bank, and those are obviously 0% yielding assets, right? If you hold a dollar bill or a physical euro, you're not getting paid interest on this. So that's obviously already a good start for them, right? They have 0% liabilities there. But they have other liabilities that, for example, consist of bank reserves. So much like how we deposit money at a bank, and that's our asset and their liability, banks have to deposit their cash, their spare cash, at the central bank. And that's an asset for the bank, and it's a liability for the central bank. And just like how a bank pays interest, a central bank also in many environments does pay interest on those reserves. And the reason they do that is because it's an important part of how they manage their short-term interest rates. It basically presents a floor, right? If you can put reserves in the central bank, and get say 5% interest on it, there's no reason why you would lend to anyone else at below 5%, because you're just taking on more risk and for less return, right? And so that's one of their important policy tools. And then there are other liabilities they can do, like reverse repos and things like that. They get more complex, and some of those do pay interest. So that's the central bank's liability side. On the asset side, it actually looks pretty similar to a commercial bank. They have things like treasuries, the government debt of whatever country they operate in. So those pay interest. They also often have mortgage-backed securities, right? So they have mortgage exposure. Obviously, these details would differ around the world, but for example, the Federal Reserve has a lot of mortgage-backed securities. These also pay interest. And then in some countries, they'll have things like corporate debt, or they'll have things like equities. Those are generally considered less traditional types of assets for central banks to hold, but you see some like Japan kind of going that route, and sometimes like the Fed and others will do that temporarily during crisis, things like corporate debt. And in most contexts, the Federal Reserve's assets are bigger than their liabilities, and they pay a higher interest rate than their liabilities. And it will then differ from jurisdictions, but usually the central banks operate like utility, where it has to pay its excess profits back to the government. It doesn't just keep building capital like a commercial bank would. Although in some jurisdictions, they actually you can publicly hold shares of a central bank. And they will, they could pay dividends, they could do things like that. But if you look at the Federal Reserve, so it's not publicly held, but it is held by banks. They basically pay a small dividend to their owners, they pay their operating expenses, and then they have to send the rest of their profits back to the Treasury, right? And so it's actually a source of income for the Treasury. And it kind of makes it so that any sort of treasuries held by the Fed are effectively interest-free, because they are paying interest on them, but a lot of these profits are just getting sent right back to the Treasury. The challenge in recent months, really ever since September, is that the Federal Reserve increased interest rates so quickly and so significantly, and for the first time, they got above the prior cycle's high in terms of interest rates, or at least the first time in decades. We've had this kind of declining trend of lower highs in terms of interest rates, but they actually got way above that. And so their liabilities pay higher interest rates than their assets. And so obviously their bank notes are still paying zero, but their other areas, their bank reserves and their reverse repos in the Fed's case, are paying a higher interest rate than their treasuries and their mortgage-backed securities that in many cases are longer duration, they're fixed rate, they're not adjusting upwards, they hold them from years ago. And so they have a mismatch. And so one is they're no longer profitable, they're not sending any more remittances to the treasury. And two, if they were a normal commercial bank, they would be on the verge of bankruptcy. So they're months away from having negative tangible equity, which is any normal bank would be bankrupt. But because of the central bank, they get to that's where they have a very, very big difference. They basically get to just put a placeholder there that kind of is like an IOU. And so in the future, if they're ever profitable again, then before sending more money to the treasury, they get to pay themselves back. So basically, they're losing money. They're going in towards negative tangible equity, but they're filling that negative equity gap with IOUs on their future income, which of course for any private entity would be red flags all over the place, absolute catastrophe. You wouldn't touch it with a 10-foot pole, but it's different if you're the central bank. But even though it's different, it does have some important ramifications. I've been talking for a while, so I'll stop. But that's essentially the high level overview of what happened here. Yeah, it's a good set of questions, and there's a couple avenues to approach it on. One, we can talk about why a central bank should be profitable, and then we can go into the second question. So the main reason you want a central bank to be profitable is that you want them to be independent, or at least as independent as they can be. The worst case scenario is to have a central bank that's completely beholden to like the central government of that country, because if that's the case, they can do things like call the central bank head and tell him to cut interest rates 6 weeks before a election, for example. Right? You can get very, very manipulative very quickly if the government actually controls the central bank, controls the price of money for the entire economy, can do all sorts of things like that. And so for that reason, most central banks are designed to be somewhat independent in the sense that they're not completely independent, but they're governed by laws, and their leaders are often appointed by the country's Congress, Parliament, leaders in various ways, but with terms that are pretty long and that are hard to dismiss, so the president can't just call them up and tell them to do something. And part of what maintains some degree of credible independence is that the central bank is not like financed by the government, right? Because if you have independent terms and things like that, but the government can just shut off your funding unless you do something, then you're not independent, right? And independence is a limited concept in the sense that it goes away during war, pretty much. It goes away during absolute crises. But on a normal operating basis, election cycles, things like that, it is supposed to be pretty independent. And so maintaining positive equity, maintaining some degree of profitability is important for a central bank's independence. If they have deeply negative equity, if they're operating on massive losses, that becomes a problem. And so that's one where it's relevant when you start to see a central bank with negative tangible equity and kind of no path towards profitability in the foreseeable future. That's a challenge. Number two is that in this world of rising deficits, some of these things that we're kind of desensitized to, right? So, for example, the U.S. Treasury just lost $100 billion revenue source per year from the Fed. And we're like, well, I mean, we're talking about trillions now. Who cares about 100 billions? But for context, that's about 4 times the size of NASA's budget, right? If you heard that, the government's going to 4 times the size of NASA's budget, there are a lot of people that be like, oh no, we can't. We're just going to keep spending now. We're just going to keep, doing this. Whereas on the other side, we just lost a revenue source that's 4 times NASA's budget. So that's 100 billion more Treasury debt that has to be issued each year, all else being equal. So that's number one. And number two is the fact that, so for the past 40 years, we've had, in many developed countries, rising debt to GDPs at the public level, but it's been offset by declining interest rates. And so the interest servicing cost, especially as a percentage of GDP, has not been rising. In many cases, it's been falling or flat. And the problem that we now face is that we have, we hit zero or even slightly negative in many countries. Now we kind of bounced off zero. Now we're kind of sideways to up, while deficits are still being accrued, debt is still being accumulated, and so we're paying higher interest on higher debt, and that's where you risk a fiscal spiral. I think that, I mean, a good analogy is the European sovereign debt crisis, when you had just basically, you know, people no longer trusted the fiscal solvency of many southern European countries. Their interest rates exploded, and if unaddressed, that would just spiral into a fiscal default essentially. And so that can also happen in other countries, with the difference being that they have more levers they can pull internally one of the to finance basically, their own. If you had elected central bankers, especially on kind of the same term cycle as other political leaders, you generally have a lot of agreement between the central banker and the government, and so you probably would give the government more control over the price of money and generally financing. In the United States, for example, we have the Supreme Court. They're not elected, but they're appointed by the people we do elect, and they have indefinite terms, which is kind of a debate in its own sake. But either way, their terms are much longer than other ones. And generally, you don't want to see outright political comments from a Supreme Court justice, even though the court at the times does become very politicized. And it's kind of the same thing with central bank. Like, you expect political comments out of your president, you expect political comments out of your your Congress, your parliament. But generally, in a lot of countries, you kind of the society and the government is structured around where you don't really want to hear political comments out of your Supreme Court justices or your central bankers. They're kind of meant to be a different type of political leader in a way, even though they still are political leaders. And so in some ways it's like an illusion, but it is somewhat of an important illusion, and it does have some tangible effects. I mean, right now, for example, Jerome Powell. I mean, last I checked, he's registered Republican, for example, under a Democratic president. But even when Trump was in charge, Trump was criticizing Powell for raising rates. And because we do have some degree of independence. I mean, Powell is basically not subservient to any president. He can't just be fired. He's not part of the executive branch, and that is important. And he can't have his, it's harder to have his funding source pulled if the central bank is a profitable institution. And in order, the government can override the central bank. They can change the laws that they operate with, but in a divided government, that's hard to do, right? So the president can't do that unilaterally. It takes a pretty big consensus of government to do that, and so central bank independence is kind of a spectrum, right? In a what you would call quote unquote banana republic, it's generally when you see like massive deficits, people say, oh, that's banana republic stuff, and it's like, well, because you're generally talking about jurisdictions that don't have these strong institutions that are some degree of separate and kind of balancing each other out, whereas in the United States and in a number of other developed countries, you at least have some degree of central bank independence. And but it does start to erode at times of crisis or war, which has also been a big theme of my macro research. That I do think, in general, this is an era of much closer interaction between the central bank and the Treasury, because the central banks get overridden in many other ways. Basically, one of their mandates is financial stability, and sometimes the government can mess stuff up so bad that the central bank has to do things they prefer not to do in order to maintain, basically like avoid sovereign default, or keep markets liquid, things like that. And they become heavily politicized, and so this is that's why I keep comparing the 2020s to the 1940s, which is not a great analogy. And I hope that obviously certain things are very, very different than the 1940s, but in a lot of macroeconomic so ways, basically money supply growth is kind of similar. Is heavily correlated with inflation, especially on a persistent basis, not like a year-over-year basis, but on say rolling 5-year periods. Money supply growth and price inflation are pretty heavily correlated. And money supply growth can come from one of two main avenues. One is bank lending, right? So as banks lend more, they increase the money multiplier. They lend more deposits into existence. That's one form of money creation. And the other one is very large fiscal deficits, especially when they're monetized by either the central bank or the commercial banking system. And those are the two avenues for how a lot of money can be created. So, for example, the 1910s, 1940s, and recently, due to the whole pandemic stimulus, those periods of rapid money creation were mainly fiscally driven money creation. Whereas the 1970s, that everyone thinks of when they hear about inflation, that was, in many cases, there was fiscal deficits, but they were smaller. And instead, you had peak bank lending. And a lot of that was because you had peak demographics, right? So the baby boomer generation was entering their home buying years, their peak consumption years for like a 20-year period, and that was a very big environment for bank lending, especially in developed countries. And so that's kind of the two avenues when thinking about. And during the 80s, in order to try to quell that bank lending, Paul Volcker raised interest rates super high, and then basically those rates stayed pretty high even after him for quite a while, and he started to get much higher debt to GDP. Right? So from the 1940s to the 1970s in the United States and many other countries, you had declining debt to GDP. A lot of that was financial repression, so interest rates were below the prevailing inflation rate about half the time, and so you basically you had nominal GDP kind of catch up to the debt in many cases. But either way, you had declining debt to GDP. But starting in the early 80s in the US and many other countries, you had rising debt to GDP, which became pretty structural. Um, and so by the end of the 80s, you had a lot of concerns around the debt and interest servicing. And so, for example, the famous like U.S. national debt clock in New York was installed in the late 1980s. And we had Ross Perot in the early 90s run as an independent political candidate, one of the most successful independent political candidates in history. Like he actually had a meaningful percentage of the vote, which is normally just Republican or Democrat, and he ran on a platform of basically the debt's a problem, right? So that whole period was kind of a crescendo, and people getting very concerned about debts and interest on the debt.